Stay with me on this one, because what I'm about to show you isn't just another gold price update or investment tip from someone trying to sell you coins. This is something that happens maybe once in a generation, something so significant that when historians look back at this moment, they'll mark it as the point when everything changed. In the last 12 months, gold has done something it hasn't done since 1971. That's not hyperbole. That's not clickbait designed to waste your time. That's a mathematical fact with implications so profound that most people have no idea what's actually happening right now, even as it unfolds in plain sight. Let me take you back to August 15th, 1971, because understanding what happened that day is essential to understanding why what's happening now matters so much. That was the evening President Richard Nixon appeared on television and announced that the United States would temporarily suspend the convertibility of dollars into gold. Temporarily. That was the word he used. It wasn't temporary. That single decision fundamentally transformed how money works, not just in America, but across the entire global economy. Before that moment, every dollar in circulation was theoretically backed by gold, sitting in Fort Knox. Foreign governments could exchange their dollars for physical gold at a fixed rate of $35 per ounce. After that moment, the dollar became what economists call fiat currency, money backed by nothing but faith in the government that issues it. Gold went from being the foundation of the global monetary system to being, according to central bankers and financial institutions, a barbarous relic with no role in modern finance. For decades, that narrative held. Gold was for preppers and conspiracy theorists. Serious investors bought stocks, bonds, real estate. Gold just sat there, doing nothing, paying no dividends, generating no returns. The smart money had moved on, or so they told us. But here's what's happening right now that forces everyone to reconsider that narrative. Gold has broken through every resistance level analysts said would hold. It's not just rising, it's surging in a way that suggests something fundamental has shifted in how major institutions view money, risk, and the stability of the systems we've all taken for granted. In 2024, gold crossed $3,000 per ounce for the first time in human history. $3,000 for a single ounce of metal. But here's the part that should genuinely concern you. The price isn't what matters most. Prices rise and fall all the time. What matters is the speed, the consistency, and most importantly, who's buying. Because when you look at who's accumulating gold right now, the picture becomes genuinely alarming. Central banks, the very institutions that spent 50 years telling us gold was irrelevant, are buying more gold than at any point since 1971. Let that sink in. The people who print money, the people who manage monetary policy for entire nations, the people who have every incentive to convince you that paper currency is perfectly sound, those people are quietly, systematically converting their dollar reserves into physical gold at a pace not seen in over 5 decades. In 2022, central banks purchased over 1,000 tons of gold. In 2023, they bought even more. In 2024, the buying accelerated further. These aren't speculators hoping for quick profits. These aren't retail investors following trends. These are the institutions that control the global financial system, and their actions tell a very different story than their public statements. Ask yourself a simple question. If gold is just a barbarous relic with no role in modern finance, why are central banks buying it at record rates? Why is China adding hundreds of tons to its official reserves every year? Why is Russia building a gold stockpile that now exceeds anything they've held in modern history? Why are Poland, India, Turkey, Singapore, and dozens of other nations suddenly desperate to get their hands on physical metal? The answer is one that central bankers don't want to discuss publicly, but their actions make unmistakable. They're hedging. They're preparing for something. They're positioning for a future where the current monetary system doesn't work the way it has for the past 50 years. Here's what nobody in mainstream financial media wants to explain. The system created after Nixon closed the gold window in 1971 was always an experiment. It was based on the idea that you could separate money from any physical constraint, that governments could print as much currency as they needed, and that sophisticated central banking could manage the consequences indefinitely. For 50 years, that experiment appeared to work. Economic growth continued. Inflation was mostly contained. The dollar remained the world's reserve currency. But every experiment eventually produces results, and the results we're seeing now suggest the experiment is entering its terminal phase. Since 1971, the US dollar has lost approximately 97% of its purchasing power. That's not opinion. That's not interpretation. That's the direct mathematical consequence of printing trillions of dollars without physical constraint. A dollar in 1971 bought what would cost you nearly $30 today. Meanwhile, gold has risen from $35 per ounce to over $3,000. That's not gold becoming more valuable in any absolute sense. That's the dollar becoming worth less. The gold is doing exactly what it's done for 5,000 years of human history. It's holding its value while paper currencies slowly evaporate around it. But something changed in 2024. Something that breaks the pattern we've observed for decades and signals a fundamental shift that's only beginning to unfold. For decades, gold moved in predictable patterns. It rose during crises and fell during periods of stability. It spiked when inflation appeared and retreated, when central banks claimed to have things under control. Investors treated it as insurance, something you held a small percentage of just in case, but nothing that would define your wealth. That pattern has shattered. Gold isn't just rising during crises anymore. It's rising during supposed stability. It's rising while stock markets hit new highs. It's rising while unemployment remains low. It's rising while central bankers insist inflation is under control and the economy is fundamentally sound. That disconnect between official narratives and gold's behavior is the signal you need to understand. When the price of the oldest money on earth starts screaming that something is wrong, and it's screaming louder than at any point in 53 years, you should probably pay attention. Let me show you what's actually driving this, because it's not what most financial commentators want to discuss. The United States national debt has crossed $34 trillion. That number is so large it's almost meaningless to most people, so let me put it in perspective. If you started counting $1 per second from the moment you were born and never stopped, never slept, never paused, you would need over 1 million years to count to 34 trillion. That's the debt load the United States has accumulated, and it's growing by roughly $1 trillion every 100 days. The interest payments alone on that debt now exceed $1 trillion. Annually, that's more than the entire defense budget. That's more than Medicare spending. That's money that produces nothing, builds nothing, and defends nothing. It simply services the debt accumulated by previous spending. And here's the mathematical reality that nobody in Washington wants to confront. There are only 3 ways to deal with debt of this magnitude. You can default, which would collapse the global financial system overnight. You can dramatically cut spending and raise taxes, which would trigger immediate recession and is politically impossible. Or you can inflate the debt away by printing money, which destroys the purchasing power of everyone holding dollars. Central banks around the world are watching this math. They're not stupid. They understand that the United States has no politically viable path to fiscal responsibility. They understand that the only realistic outcome is continued money printing, continued currency debasement, and continued erosion of the dollar's value. And so they're doing the only rational thing available to them. They're converting their dollar holdings into something that cannot be printed, cannot be debased, and has held its value for 5,000 years of human history. This is why gold is behaving differently than at any point since 1971. It's not responding to temporary crises or short-term inflation fears. It's responding to a structural breakdown in the global monetary system that central banks recognize, even as they publicly deny it. But the dollar's debt problem is only part of the story. Something else is happening that accelerates this shift dramatically. The weaponization of the dollar has changed how the world views American currency. In 2022, following Russia's invasion of Ukraine, the United States and its allies froze approximately $300 billion in Russian central bank reserves held in Western financial institutions. From a moral standpoint, you can argue this was justified. From a strategic standpoint, it sent a message that every nation on earth received clearly. Dollar reserves held in Western institutions are not truly yours. They can be frozen, seized, or confiscated if you cross political lines drawn by Washington. For countries like China, India, Saudi Arabia, Brazil, and dozens of others who maintain complex relationships with the United States, this was a wake-up call. Their dollar reserves, accumulated over decades of trade, could evaporate overnight if geopolitical tensions escalated. The response has been predictable and profound. Nations are diversifying away from the dollar at an accelerating pace. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with new members including Iran, Egypt, Ethiopia, and the United Arab Emirates, are actively building alternative financial infrastructure. They're creating payment systems that bypass the dollar entirely. They're settling trade in local currencies. They're accumulating gold as a neutral reserve asset that no foreign government can freeze or seize. This isn't speculation about what might happen someday. This is happening right now, in real time, with measurable consequences. In 2023, the dollar's share of global foreign exchange reserves fell below 59% for the first time in decades. That's still dominant, but the trajectory matters more than the absolute number. Every percentage point decline represents hundreds of billions of dollars being redirected away from American currency into alternatives, and gold sites at the top of that list. China has been accumulating gold aggressively, adding to official reserves for 18 consecutive months, while likely holding far more in unreported accounts. Russia has built reserves exceeding 2,000 tons, providing a financial cushion against Western sanctions. Even traditional American allies are quietly increasing their gold holdings, hedging against a future where dollar dominance cannot be assumed. This is what gold is telling us. Not that a crash is coming tomorrow, not that you should panic and sell everything, but that the foundational assumptions underlying the global financial system are shifting in ways that will define the coming decades. The 40-year period of unquestioned dollar dominance, of American financial hegemony accepted by friend and foe alike, is ending. What replaces it remains uncertain, but gold's historic surge suggests that the people who manage nations' wealth are preparing for a very different monetary landscape. And here's what should concern you most. The general public has no idea this is happening. Mainstream financial media covers gold as a curiosity, a commodity like copper or oil, subject to the same supply and demand analysis. They miss the deeper significance entirely. This isn't about commodity prices. This is about the fundamental nature of money and who controls it. The central banks understand this. The question is whether you understand it before the transition accelerates further. Because what happens next will affect everyone holding dollars, everyone with retirement accounts denominated in dollars, everyone whose wages, savings, and future are tied to a currency that may not hold its value the way it has for the past 50 years. So what does this mean for you? What happens next in a world where the monetary foundations that have defined global finance for half a century are visibly cracking? The honest answer is that we're entering uncharted territory, and the range of possible outcomes spans from managed transition to genuine crisis. But certain trajectories are already visible, and understanding them is essential for anyone trying to protect their wealth in the years ahead. The first trajectory is continued gradual debasement. This is the most likely near-term scenario and the one central banks prefer because it's least disruptive to their power. Under this scenario, inflation runs persistently above historical norms, perhaps 3 to 5% annually, instead of the 2% target. Real interest rates remain negative, meaning the return on savings fails to keep pace with rising prices. The dollar doesn't collapse dramatically. It simply loses purchasing power year after year, decade after decade, until the cumulative erosion becomes impossible to ignore. Gold continues rising in this environment, not in straight lines, but in an upward trend that reflects ongoing currency debasement. People who hold physical assets maintain their purchasing power. People who hold paper assets denominated in depreciating currencies watch their real wealth slowly evaporate. The second trajectory is accelerated de-dollarization. If geopolitical tensions escalate, if more nations face sanctions or fear they might, the movement away from dollar reserves could accelerate dramatically. Under this scenario, the carefully managed decline becomes a rush for the exits. Countries dump treasury holdings to acquire gold, commodities, and alternative currencies. Interest rates spike as foreign demand for American debt collapses. The Federal Reserve faces an impossible choice between letting rates rise, which would trigger recession and potentially crash housing and stock markets, or printing money to buy the debt foreigners are selling, which would accelerate inflation and further undermine dollar confidence. Gold doesn't just rise in this scenario. It potentially experiences the kind of parabolic surge last seen in the 1970s, when it increased from $35 to over $800 in less than a decade. The third trajectory is monetary reset. This is the scenario central banks don't discuss publicly, but are quietly preparing for. Throughout history, when currency systems become unsustainable, they don't reform gradually. They collapse and get replaced. The gold standard ended in 1971, not through careful planning, but through crisis, with Nixon closing the gold window because foreign nations were draining American gold reserves faster than policy could respond. A similar reset could occur if confidence in the current system deteriorates beyond recovery. Under this scenario, gold doesn't just rise in dollar terms. It becomes the foundation of whatever new monetary architecture emerges, just as it has following every major currency collapse in recorded history. I'm not telling you which scenario will unfold. Nobody can predict that with certainty. What I'm telling you is that all three scenarios share one common element. Gold maintains or increases its purchasing power while paper currencies lose theirs. That's not a prediction. That's 5,000 years of historical pattern recognition. And it's what central banks are betting on with their record purchases. Now here's what most people get wrong about gold. And it's critical you understand this. Gold is not an investment in the traditional sense. It doesn't generate earnings. It doesn't pay dividends. It doesn't grow through innovation or market expansion. Measured against itself, an ounce of gold today is the same as an ounce of gold 100 years ago. What changes is not gold's value, but the value of the currencies measured against it. When gold rises from $35 to $3,000, the gold hasn't become more valuable. The dollar has become less valuable. Gold is not the thing moving. It's the thing standing still while everything else shifts around it. This is why central banks are accumulating gold. They're not speculating on price increases. They're preserving purchasing power against the currency debasement they know is coming because they're the ones who will implement it. They understand that in a world where governments can print unlimited money, the only financial assets that maintain value are those that cannot be printed: land, commodities, and above all, gold, which has served as humanity's monetary anchor for longer than any nation currently in existence has existed. The question you need to ask yourself is simple. If the institutions that create money are converting their reserves into gold at the fastest pace since 1971, what does that tell you about their confidence in the money they're creating? If central banks are hedging against dollar debasement, shouldn't you consider the same hedge? I'm not here to tell you to sell everything and buy gold. That would be irresponsible. And anyone who gives absolute financial advice to strangers on the internet should be viewed with suspicion. What I am telling you is that the monetary system is shifting in ways not seen in half a century. that the people with the best information about currency stability are positioning accordingly, and that ignoring this shift because it's uncomfortable or inconvenient doesn't make it less real. The gold surge we're witnessing isn't about short-term trading opportunities or commodity speculation. It's a signal from the deepest pools of capital on Earth that confidence in fiat currency is eroding. Its institutions voting with billions of dollars, not with words. And their vote is unmistakably clear. They're choosing the asset that has outlasted every paper currency in human history, the asset that maintains value when governments make promises they cannot keep, the asset that cannot be printed, debased, or inflated away by politicians facing uncomfortable choices. Gold just did something it hasn't done since 1971. It's telling us that the post-Bretton Woods monetary experiment, the 50-year era of unlimited money printing and debt accumulation, is approaching its limits. What comes next remains uncertain, but one thing is clear. The central banks are preparing. The question is whether you're paying attention. If this breakdown helped you understand what's really happening with gold in the global monetary system, hit that subscribe button and share this with someone who needs to see what's unfolding beyond the headlines. And in the comments, I'm genuinely curious. Do you think we're heading toward a gradual erosion of dollar purchasing power, a more dramatic de-dollarization event, or something even bigger? Let me know what you think.